The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
For U.S. equities, low volume doesn't necessarily mean low volatility. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Scarlett Fu. We're kicking off to the closing bell here in the U.S. A holiday-shortened week. The bond market already closed, so we're talking about the final hour of trading here in equities. Are
we going to celebrate in this final hour?
Well, we'll see. We still have an hour to go, right? So far, hopes for some kind of trade deal is giving stock support. We are hearing talks of progress in discussions with the European Union, with Japan as well. The Secretary of the Treasury has brought up other countries that are lining up to speak with the U.S. as well. But one area of concern in the equity market is the healthcare equipment and services index. That is down 5.25%, and that is after insurer United Health cut its earnings outlook. So a big concern there. 10-year yields moving up, actually across the curve, up by 4 basis points to 4.32%. The bond market, of course, closing early, and the euro losing ground by 0.25% after the ECB cut interest rates again, the 7th time since June. Romaine.
And as we close it out here in U.S. equities, a low-volume week coming to an end ahead of that Good Friday holiday. We should point out the Treasury market did already shut down at 2 p.m. While the equity market's getting ready to badge out as well in about an hour's time. The holiday-induced doldrums offering some respite for investors today. Though we should point out that the calm was still marked by high volatility underneath the surface. Realized volatility over the past 10 days, that's holding at the third highest of the modern era, third only to the GFC in 2008 and the COVID pandemic in 2020. As far as the optimism out there, it can be found, at least when it comes to the potential for trade deals. We did learn that the U.S. and Japan did kick off some modicum of negotiations, and Trump signaled potential progress on a separate minerals deal. Who knows? Next Thursday is when he says we're going to find out. Encouraging reports today from Charles Schwab and American Express also putting a floor under prices today, and that might actually propel the S&P to its best close of the week. Maybe. Meanwhile, the Dow, though, not headed for its best close of the week by any measure, dragged down by a pessimistic report from United Health, the first earnings miss out of that company in a decade, blindsided by rising medical costs, and that blindsided investors who had viewed healthcare stocks as a safe haven in the economic storm. So if not healthcare, then how about Netflix as a defensive play? That company reporting after the bell, high expectations. The internet company was actually going to be insulated from the tariff turmoil that has battered most other stocks.
All right, well, we'll see how that plays out. I know I won't be canceling my Netflix subscription anytime soon, and that's what people are counting on. When you look at the turmoil that Romaine mentioned, markets have really calmed down considerably from last week's volatility fest. Just look at stocks, for instance. This is the S&P 500, and its swing today measures only about 1.2% from peak to trough, slightly below this week's average move of 1.8%, which are both a meaningful decline from last week's moves, and you can really see it here, especially the 10.8% swing last Wednesday when President Trump announced a 90-day pause on his reciprocal tariffs. That was really the outlier so far over the past 12 months. But as everyone we speak to points out, don't expect the volatility to simply go away as investors and traders await the outcome of ongoing trade talks and companies try to prepare for an unknowable future. Romaine?
All right, let's get things going here. We got a jam-packed show with some of the best and brightest on Wall Street and beyond. That includes Binky Chadha, Chief Global Strategist and Head of Asset Allocation with Deutsche Bank. Great to see you, Binky. I hope you got a little rest this week because relative to the last couple of weeks, it was somewhat calm. That might break. But longer term, when we start to talk about, I guess, the rock and a hard place that a lot of investors have found themselves in between whatever's going on in Washington and whatever the ripple effects might be in the economy, do you see any hope for a longer term respite?
Yes, I do, actually. But what I would, characterize where we are right now is, given everything that's happened, it should not be surprising, to see that basically, if you look at the positioning of equity investors, I mean, we are actually a little bit outside the range on the downside that we typically inhabit. So, the market is clearly short. Being so short makes the market very vulnerable basically to squeezes on positive news or hope of positive news or rumors of positive news. and that's giving rise basically to the volatility that we've seen. I would actually map out the very wide range that the S&P 500 is likely to remain in for the next 1 to 3 months as being between 4,600, which would correspond basically to pricing in an average or typical recession. It would be 25% down from the peak.
Right.
And on the upside, I would cap it where basically positioning is neutral. So on our Z-score measure, it's at 0 basically. And the longer term or the medium and longer term, our base case is that we will get some form of a relent basically on the policies.
Does that relent actually sort of put markets back on an even keel? And by that, I'm basically referring to where prices were back in January and February when we were at record highs on equities and at pretty significant levels on some of the other asset classes as well.
Absolutely. The question, though, is, when we will get, or if and when we will get that relent. And of course, the cumulative impact of the uncertainty that's going on means, the hard data and the economy is pressured down. Earnings are absolutely key, and if you think about just the incremental increase in the tariff and you multiply by the volume of goods imports from last year, I mean, that's an enormous number. It's about $750, $800 billion, and somebody has to pay that. If you look at, foreign exporters, the margins tend to be on the low side.
Yeah.
I'm talking about very high value added exports to the US. And so their ability to absorb is relatively limited. That leaves US companies and US consumers. Given the history of the last 2 years of inflation, companies, are very hesitant to raise prices. You raise prices, you lower volumes, your revenue's still flat, whereas your operating leverage has gone down, and that's negative basically for margins from the growth channel. So, one prospect is if these tariffs stay at these levels, they're very large.
Right.
The $750 billion, if it's going to be paid by corporate America, that's bigger than corporate tax revenue.
Yeah.
It's 35 to 40% of annual earnings for the S&P 500. So
that's pretty striking.
Very large numbers.
Yeah, something that investors will have to fold in. A lot of what they have to fold in is kind of unknowable, and we saw that with how companies are trying to get a handle on their forecasts. United came out with this bimodal forecast, right? A base case and a bear case. What you pointed out to me was really interesting. It did not give a bullish case. What does that suggest?
That suggests that the bias is to the downside, and I remain negative on equities here. I think, we can get all the way down, but at that point, kind of like where we are, you're going to be very prone to squeezes. So, I think basically volatility continues for now.
It continues for now, and I had asked you earlier whether there was anything in your career that prepared you for this kind of moment with the volatility and the unexpected decision-making and policy-making that's coming out of Washington. And you noted that you worked at the IMF and you worked in emerging markets, and particularly looking at financial markets with relation to emerging markets. And this has there are a lot of parallels here.
The price action, I mean, if you think about equities, bonds, and the dollar, is very strong parallel with a run basically on an emerging market, which unfortunately has happened historically very frequently.
When you hear people though talk about sort of the loss of American exceptionalism, or at least that we're seeing the real decline of that, does that make sense to you, or is that just hyperbole?
I wouldn't put it in those words. I mean, if you think about the U.S. dollar, since it floated, basically, it's been in a band with one exception in 1985. And we've really been sitting at the top of the band for many years. So it is the fact that I don't call it U.S. exceptionalism because the U.S. was normal, whereas everybody else was not growing. So in a relative sense, yes, you could argue it's exceptional. So the initial condition is there. I mean, historically, the dollar has done these long multi-year cycles. And we now have a catalyst to begin the down cycle. And I would just point out that the bottom of the band is 0.40% below where we are sitting this morning.
Well, let me put an asterisk on that question. We only have about 30 seconds, though. Are there alternatives? Because, I mean, it's easy to say, oh, okay, everyone's going to run from the dollar or run from treasuries. Run to where?
So, you know, I mean, we've had past dollar down cycles that lasted many years. So, you know, they run home, basically. That's the issue. Everybody's been massively overweight for the reasons you just mentioned, U.S. assets. And we've had the growth, we've had the earnings. And if that now comes into question, you know, it's as much about new money coming in as, you know, where we'll go. Alternatives, I would argue you should buy Europe.
All right, Binky, it's a great place to leave it. Great to have you here. Binky Chadha, Chief Global Strategist and Head of Asset Allocation with Deutsche Bank. Scarlett.
All right, let's talk about deal making, because a major deal today in fintech appears to be bucking the frosty M&A trends that we've seen this year. Global Payments is acquiring payment processor WorldPay by buying out stakes that both Fidelity National Information Services, known as FIS, and a private equity firm owned. The price tag, more than $24 billion. At the same time, Global Payments agreed to sell its issuer solutions business to FIS for $13.5 billion. Here now to discuss this three-way transaction is Stephanie Ferris, CEO of FIS, and Cameron Bready, CEO of Global Payments. Welcome to both of you.
Thank you.
Cameron, let me start with you because your transaction is the bigger of the two. How does this three-way deal change the payments processing business at large and for your company specifically?
Well, for us specifically, it's a tremendous opportunity to really transform our business. It allows us to divest our issuer businesses to FIS, which I think is a good home, and FIS will be a great steward for that business long term. And then it allows Global Payments then to become a global leader in merchant solutions technology. We'll have unmatched global scale and reach. We'll process $4 trillion of payments volume annually. And it really allows us to expand our business into more enterprise and e-com, enhance our capabilities to serve software and platform partners, and give us an embedded base of SMB customers and additional distribution to bring our products to market. So for us, it allows us to be more focused as a business, gives us clarity of strategy going forward to be a pure play merchant provider, and obviously financially expands our business massively as well, with obviously a nice financial profile from an accretion perspective.
And Stephanie, let me turn to you because you're buying the Global Payment Solutions business, and a lot of people have described that as kind of the crown jewel. It's seen as a steady Eddie kind of business that's not really correlated with macro conditions, which is pretty important in this kind of environment.
Yeah, we are. We're very excited. It's a win-win, as Cameron mentioned, for both companies and all parties involved. From our standpoint, we've really been focused on making sure that we are consistently executing our strategy, which is focusing on our clients, primarily financial institutions and large corporates. And this issuer processing business for us enables a new product and service that we can sell into our financial institution base. So we're very excited about it. We also think it's a crown jewel, so we very much excited about the partnership between Cameron and I, and then receiving that crown jewel from him.
I am curious. I mean, you mentioned obviously the connection that you have with the world of finance, and we talk about, I don't know, there's probably not a PE firm in the world right now that isn't sort of integrated into FIS in some way or another. What is the complement to the existing services you're already offering that this deal provides?
Yeah, it's a great question. So we think we're uniquely positioned. We provide core banking technology, digital banking technology, debit processing, network processing, trading and processing, as you said, across the financial institution from A to Z. So whether you're a capital markets participant, a private lender, a small bank, or a large bank. We were lacking credit processing at scale, which was the issuing business that we're buying from Cameron. So this is very significant for us because it's a product set that we didn't and we couldn't enable into those banks that we serve. And it is a very, very strong asset, so we're very excited about it.
I do have to ask you, Cameron, and I mean, I understand the synergies for these deals on both of your ends. I do also have to point out that WorldPay was, to a certain extent, was supposed to be the future, to a certain extent, of FIS. You have a history, Stephanie, with WorldPay in your previous roles. Why do you think, Cameron, that you can make WorldPay work under your umbrella in a way that maybe it couldn't have worked under FIS?
Yeah, I think with us, it's the fact that it's a highly complementary to business to what we're operating today. I think when FIS acquired WorldPay several years ago, they're different businesses. Merchant acceptance is different than providing core banking and financial technology to financial institutions around the globe. And I think the nice thing about WorldPay is it's extraordinarily complementary to our business. Where we have strength, particularly in the SMB segment around point of sale technology, payment acceptance, other commerce enablement solutions, that's not an area of strength for WorldPay, and vice versa. Where they have strength, particularly in e-commerce, enterprise solutions globally, they have a best-in-class platform to serve some of the most sophisticated multinational e-commerce and enterprise customers. That's a hand-in-glove match as far as I'm concerned, and we believe the combination of these two businesses is going to be extraordinarily powerful.
Are you two competitors? Or you don't see yourselves as competitors at all?
Not after this transaction.
Not anymore.
Not anymore. Now you're friends. Okay.
Not anymore. No, Stephanie and I have known each other for a decade, and I think part of what allowed this transaction to happen, given the complexity of it, is the level of respect and trust that we have with each other. And I think, obviously, she's getting a great business from us. We're getting a great business from her, and it's going to make both of our businesses better for the long term. And that's the value proposition that we're most excited about.
If nothing else, the relationship is now a little bit complicated. Stephanie, I got to ask you, this deal needs to pass antitrust hurdles. How do you think this current administration will view this transaction, certainly as opposed to the previous administration?
Yeah, I mean, we think that we're very confident in terms of the two businesses being complementary. So on our side, FIS, it's complementary. On Cameron's side, it's also complementary. So we'll go through the regulatory process, but we don't have great concerns. We're very confident in terms of these businesses being complementary, and it's a very competitive environment. He has a great set of competitors. I have a great set of competitors, and we're all focused on serving our clients.
Speaking of your competitors, Cameron, you have fintechs like Toast, Clover, and Square building up a lot of momentum by targeting specific sectors, for instance, the restaurant industry. Is that something you're considering as well, or do you prefer a more general approach amid this intensifying competition?
No, we do have technology that competes with those very names that you mentioned earlier. POS is a battleground, particularly in restaurant and retail, and it's really the mode of competition by which we gain new merchant customers for our payments business. So we have very competitive point of sale products. Genius is what we call ours, that attacks the restaurant and retail vertical markets. And a big part of the thesis in acquiring WorldPay is it gives us more distribution to sell into and an embedded base of customers that we can tap into as well with our point of sale solution. So that's very much a point of focus and emphasis for us. But as we think about the business more broadly, the unique thing about global payments is we're going to be able to provide services from the smallest SMB all the way up to the most sophisticated multinational enterprise customer, and to be able to serve the entire merchant spectrum as a pure play merchant provider, we think is a powerful thesis for our business.
Stephanie, I want to give you the last word, and I am curious, since you've taken over the company, the reaction, I think, amongst the Wall Street community has been very laudatory, and a lot of that had to do with the M&A focus that you had coming in, and I assume that we haven't yet seen it all yet. Is that M&A environment and that M&A push, is that still there? You still have that drive right now?
We're very excited about this transaction. We like to do transactions that are aligned with our strategy. This is right in line with our strategy. We'll continue to do those.
Do you see other opportunities like this?
Absolutely, I do.
Do you want to name any of them right now on air?
Maybe later, yes, but no, not right now. But we're very excited on this transaction. As we said, it's quite transformative. We've done other deals during difficult times like this. I think what makes deals like this happen is that they're aligned with strategy, and you have a really good relationship between the sellers and the buyers and trust. That's what brings deals like this together that are complicated and during volatile times. So excited about closing this, and then we'll be on to the next.
Well, congratulations, of course, getting the deal done in this environment. Certainly a lot of work, and obviously you two appear to have pulled this off. Great conversation with Stephanie Ferris. She is the CEO of FIS, and Cameron Bready is the CEO of Global Payments. A big deal happening today, one of the few M&A deals out there as we push ahead to the close with a refocus on what's going on in public equity markets. And a bit of a rally going on right now in D.R. Horton, despite the fact that it cut its sales outlook. We're going to explain why when we come back with Jay McCanless. This is The Close on Bloomberg. All right, let's get a view from the sell side. Top calls, big movers on the back of analyst recommendations. And we start off today with Intuit. Scotiabank upgrading their call on the tax prep company to sector perform and upping their price target to $700 from $600. The analysts saying Intuit has been focused on disrupting the billion-dollar assisted tax software market, which should lead to improved consumer revenue growth. You see the shares relatively unchanged on the day, but still headed for a second straight weekly gain. Next up, Microsoft, KeyBank, downgrading the tech giant to sector weight from overweight, removing the price target altogether, with the analysts pointing to a flattening in long-term cloud demand and a slowdown in the AI revolution. Shares down about 1% on the day, down for a fourth straight day, if you can believe it. And lastly, let's take a look at Novo Nordisk. BMO cutting the market perform from outperform, reducing the price target all the way down to $64 from $105. The firm warning that weight loss drug rival Eli Lilly has made significant gains with its portfolio and overtaken Novo's early lead in the space. Those shares now headed for a sixth week of declines in the past 7. Conversely, we should point out Lilly actually setting up for its best one-day gain going back to the year 2000. Those are some of our top calls, and we stay in the sell side space with a closer look at D.R. Horton. The shares are moving slightly higher here. Investors actually shrugging off the home builder's lowered guidance for full year revenue. While high mortgage rates and economic uncertainty are weighing on buyers, the company has so far found a way to preserve its margins. Jay McCanless is Senior VP of Equity Research at Wedbush Securities. He joins us right now to talk a little bit about this. Interesting that they would kind of come up with, I guess, what we consider a bad earnings report. But you see the earnings reaction. Some of this seems to be based on the idea that if gross margins can hold up, maybe it doesn't matter that we're seeing some moderation in actual top line growth.
Yep. Good afternoon. Thanks for having me on. I think part of what is happening with the stock today is you look at the mortgage rate spike that we saw at the beginning of April was pretty severe. We saw rates up nearly 50 basis points. The fact that Horton talked on their call today about how traffic in March and April and demand as well in basically the month and a half of March and April was better than what they saw in February. That's normal seasonality, but I think with some of the volatility that we saw in rates, people were encouraged to hear that. I think the other thing, and we asked them about it on the call, is their cancellation rate was only up about 100 basis points versus last year. And the company said that buyers right now have their ducks in a row, and they have their mortgage letter ready to go. They're high intent customers that want to get a home. So once they can jump through all the hurdles to become homeowners, usually they can get those contracts to closing. So I think those two things, and probably gross margin guide for the third quarter, their fiscal third quarter, June quarter, was probably a little better than what some people had feared. So put all that together, and I think that's why stock's trading higher today.
It very much seems that holding the line on gross margin encouraged investors and encouraged the market overall. But would the market be patient and tolerate another quarter of double-digit declines in net sales orders, even if it's to preserve the gross margin?
I think at this point, people have realized that there's a lot of supply in the market right now, especially on the new home side. And so if you had to cut to preserve the gross margin, you had to cut orders a little bit, I think people might look past that. But the question in our mind is how many people at this point, especially with some of the things we've talked about, like rising property insurance rates, mortgage rates staying where they are, it's just getting harder and harder, I think, without some help on the rate side to get those people qualified. So, yeah, we'll have to see next quarter, but I don't know that they'll give them a pass for a couple quarters where orders are down that significantly.
I am curious, Jay, as to whether there was any commentary that stuck out to you with regards to their costs and, more importantly, navigating any potential roadblocks that might pop up with regards to tariffs and the ability to get their hands on the supplies they need.
Yep. So the good news that we've heard on tariffs is that Canadian building materials and materials coming in from Mexico are going to be exempt from the tariffs. What a lot of people don't realize, though, is that there were what are called anti-dumping duties, countervailing duties on Canadian lumber imports. And those have been in place long before the tariff talk that's going on right now. The Commerce Department said earlier this year that they may raise those levies on Canadian imports. So we think if that happens, that could push domestic lumber prices higher, might be gross margin negative, not only for Horton, but for the rest of the industry. But I think if you look at the other things that we were kind of worried about, whether it was appliances or drywall coming up from Mexico, it seems like the tariffs on those are on hold for now. So, besides this lumber issue that we talk about in the note, I think that the rest of the building materials inputs look okay on a tariff front.
All right, Jay, thank you so much. Jay McCanless is Senior VP of Equity Research over at Wedbush Securities. Romaine, there's a big divergence today between the Dow and the S&P 500, and it's due mainly to United Health. And it's a big earnings miss, the first in more than a decade, and more importantly, a big drawdown in its forecasts, which is rare for a health insurer that is accustomed to giving a very conservative forecast, but one that also tends to go up as the year progresses.
Yeah, I do wonder if some of this is idiosyncratic. I mean, it does appear that some of this is sort of their own doing. But again, whatever you can extrapolate on broader economic conditions, maybe that's the reason why you're seeing the stock lower. A conversation about the economy coming up next. .30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostic.
And I'm Scarlett Fu. And Romaine, this Thursday before a long weekend, did you know?
It was Friday.
Today, it's kind of Friday, but it's officially Thursday. But, the U.S. is in a lot of trade talks, apparently. Everyone's lining up to talk to us.
Well, I mean, in Japan, we know Japan was here.
Yes.
I'm told South Korea is either on a plane or on a boat or somewhere
coming
here
soon.
And other nations. In all seriousness, this is the issue, right, is that each of these countries, in theory, are going to have to come here one by one and enter into some negotiations. I guess it's a good sign that Japan has done that. Trump seemed to allude to the idea that maybe there might be something in the works with the EU. And he also teased this idea that there might be a minerals deal that he's able to announce a week from now.
Yeah, well, we'll see how it all shakes out because right now it's still pretty general, pretty vague, no timelines. But how does this all fold into how you look at the economy? For more on this, let's bring in Nathan Sheets. Nathan is Global Chief Economist over at Citi Research. So, Nathan, various talks taking place around the world, actually in the U.S. with countries from around the world. We do know that there's likely to be some kind of baseline tariff because that's what President Trump has made clear he wants to hold on to, regardless of what individual deals he strikes with countries. How do you think through what that means at the end of the day for the U.S. economy, given that we don't know how each negotiation will play out?
My expectation is that there will be some deals, but that the administration will hold to a 10% minimum reciprocal tariff. And I don't think, and time will tell, but I don't think they're going to negotiate on the sectoral tariffs that are likely to be set at 25%. So the upshot of this is we're going to see, even in the best scenario, a double-digit increase in tariffs relative to the time when Donald Trump took office. And that's going to be a historically high tariff rate, roughly matching what we saw during the time of Trump-Hawley, or let's try that again. Maybe that's what it was, Trump-Hawley. Yeah, Smoot-Hawley in the 1930s.
So the other thing, of course, is the ECB cut interest rates for a seventh time today. It dropped the word restrictive when describing its monetary policy. Most economists expect another cut in June. Is the European Central Bank ahead of the curve or behind the curve in confronting what it calls expected headwinds? Now,
a fundamental observation is these tariffs have very different implications for the European economy than they do for the U.S. For the U.S., it's stagflationary, higher inflation, weaker growth. For Europe, it's an adverse demand shock, weaker growth, lower inflation. And what you're seeing is the ECB get ahead of the tariff shock. And then at the same time, going into this shock, the European economy was softer, inflation was on a downward trajectory, and the ECB is responding. So I don't want to say one is ahead of the other. It's more that the economic situation and the set of challenges facing the economy is much different in Europe than it is in the United States and more skewed toward economic weakness.
It's kind of interesting, too. I mean, we've heard from several Fed members who've basically said what you just said, and that's a part of the reason why they're saying, look, we're going to stand pat right now. Jay Powell seemed to ratify that, if not reiterate his previous comments at the Economic Club of Chicago the other day. Is there some sense that the Fed does have it right, that maybe patience at this moment in time is the actual virtue?
Well, that's very much my view, that, the Fed has two objectives. One is low inflation, and the other one is job creation and solid growth. And the tariffs are working against both those objectives. So what do? Up front, you wait and see, and you assess which side of the mandate, which goal is more in jeopardy. But being patient up front is absolutely the right strategy for Jay Powell. And I would further say, given where inflation is, for him to be underscoring that he's going to fight inflation is the right policy. And maybe what that does is it helps anchor inflation expectations. And if inflation expectations stay where they are, then he's going to be able to cut sooner. It may allow him to get to a cutting trajectory more rapidly.
Okay, well, that's assuming he's around, because as you may have heard, that the President of the United States doesn't necessarily agree with some of the policy, decisions or lack of decisions, if you will. Yes. President Trump, earlier today, social media posts basically saying the Fed should be cutting rates, Powell is too late. He was asked about it at the White House earlier today when he was meeting with Giorgia Meloni. He said Jay Powell is terrible. And now there's a Wall Street Journal article that seems to suggest, citing unidentified sources, that for weeks they've been trying to lay the groundwork for removing Powell before his term ends. What would that do, or what message would that send to the markets if he were removed before his May 2026 departure date?
Central bank independence is absolutely an anchor for the economy and for the financial markets. And if we were to see the administration, in one way or another, take a meaningful step to compromise that independence or to violate that independence, I think we'd be in a place where the market volatility that we've seen over the past month or so would merely be the first course to a much, much larger and more challenging kind of downturn. There is a risk as we pursue policy after policy that's been previously uncontemplated, and we have it with the tariffs. If we now cross the Rubicon on central bank independence as well, that we start seriously and permanently undermining confidence in the economy and the markets.
Another form of undermining central bank independence is if perhaps Jay Powell or at the Fed or whoever else at the Fed does submit to what the president wants and cuts interest rates. And the goal from the administration is to see lower rates. Is that what they would get if the Fed were to cut rates right now?
Candidly, I think the answer to that is no, that there is at the moment real inflation risk associated with these tariffs. And if Jay Powell just stood up and said, I'm going to cut rates, I think the markets would say inflation's going up, inflation risk is going up, and you'd see a marked increase in the 10-year Treasury yield. It would push the curve in the opposite direction of the way that Secretary Bassett, President Trump, and the administration would like.
Do you have faith, though, that Jay Powell will sort of stay the course, that he takes this idea of independence so seriously that no matter how much pressure Trump puts on him, he'll stay the course?
Categorically. I think that Powell he's made several things clear, but if there's one in particular, it's that he is committed to using the tools of monetary policy to the best of his ability. And the Fed over the last 5 years has made some mistakes, but to the best of his ability to use the tools he has to achieve the full dual mandate which Congress has given him.
All right, Nathan. Well, it's a sobering thought to think that this could even happen. The fact we're having this conversation, but I love your wisdom and your relative optimism here as far as maintaining that independence. Nathan Sheets, Global Chief Economist over at Citi Research, helping us count you down to those closing bells. Just about 22 minutes before we get there, we do want to refocus here on some of the big movers of the day, and that includes shares of Alphabet, as well as shares of some other companies in the ad space, like Gannett, like Trade Desk. A judge earlier today ruling that Google illegally monopolize some online ad technology markets. That conversation is coming up next as part of our Stock of the Hour, right here on The Close on Bloomberg. Shares of Alphabet about 1% lower on the day. This after a U.S. federal judge ruled that its Google search engine illegally monopolized online advertising tech markets. That's the company's main source of revenue. Now, this is a huge hit to the tech giant, which was also found to have monopolized the online search market in a separate case. Bailey Lipschultz joins us right now, helps covers equities for us here in the U.S. for Bloomberg. All right, let's talk a little bit about this. I mean, this wasn't a total surprise. I mean, there have been some discussions in the last few weeks that it looked like they could potentially lose this ruling. Is there an appeal, and is there any sense that this would have any sort of material damage to their bottom line?
Yeah, the big takeaway from Bloomberg Intelligence analysts was basically that the Justice Department faces serious challenges in getting a divestiture. It is possible. It's going to take time. That's been the big reaction from Wall Street analysts. And while you saw that initial, call it knee-jerk reaction when it was down a little more than 3%, and now back down only a little more than 1%. The big thing is, though, the winners in this are some of their smaller competitors. So Magnite is up 14%. Pubmatic is up 13%. Trade Desk was up at one point, up 8%. Now it's up closer to 3.5%. So the consensus seems to be that this is an impact to Alphabet. It's going to take some time, but it does open the door for competitors, at least to play on a more level playing field. And as you can see, it's a pretty sharp divide between the performances.
And
Absolutely.
you forgot Gannett. Gannett's up 20%. Which
Gannett, the old school newspaper?
I know. I said the same thing. I didn't know they were still publicly traded. But, they're hanging on, Scarlett.
They are. So when we talk about the legal outcome here, this is a partial loss, partial victory for Alphabet, because Google's, the charge that Google also acted like a monopoly when it came to display ads was found in favor of Alphabet.
Yeah, so this is something that, again, kind of back to your point, there's going to be a remedy phase. This is going to probably be drawn out. Obviously, there's a lot of uncertainty around what the White House, kind of how they view big tech in particular and what that means. So it is going to be something that takes a while to play out. Citi came out saying that it adds to the bear case for people who are skeptical of the company, but also they point out that newer products, AI mode, Gemini 2.5 Plus, they're ramping. So Google is still one of the largest companies. So at about $2 trillion, it's part of the business.
Yeah, absolutely. And I mean, look, we've been down this road before with other big tech giants that have ran into antitrust troubles, and we kind of know how that typically works out. I am curious, just pushing ahead. I mean, Alphabet is scheduled to report earnings next week, in the latter half of next week. And I am curious that as we get into the broader tech season, because the sell-off we had over the last few weeks, a lot of people said that was a big tech sell-off. That was about valuations and multiples. Do you think we could see a course correction based on what you're hearing in terms of expectations for these companies?
The big thing is, how do these companies guide? Obviously, the first quarter was kind of a completely different environment for the most part. The big thing that also comes up is, how do analysts react? I was talking to a number of investors the last few days, and the question is, okay, when does the S&P get cheap in their view? And the big part of that conversation still centers around, well, there's a P and there's an E. The E hasn't come down yet because analysts are saying, we want to wait and hear from these CEOs. We want to hear how this is affecting their business and how it impacts their outlook. Until these earnings kind of hit and those analysts get back to their spreadsheets, it's still uncertain around what does cheap look like and how do different companies deal with that.
Right, and the price, the P, has been all over the place in the meantime. So we do have Netflix reporting earnings after the close today, and we like to say that it's the start of the tech earnings season, but not really, because it's in a different boat. It's seen as more resilient than some of those other tech names.
It's not exposed to tariffs. Obviously, if consumers tighten their spending and people are not spending $15 or whatever it is a month to have that as a streaming platform, the big thing is when you look at Netflix, no longer a FANG name. No one cares about that anymore. We all care about the Mag 7. But it is different. And I think that's the thing that does come back to the conversation when we get through the Mag 7 earnings season is NVIDIA, while it shares a lot of characteristics with a Google, fundamentally they operate in different ballparks.
What's the last thing you watched on Netflix? Anything? I know Scarlett watches Netflix all day.
All the time.
I watch Max and Hulu.
Yeah.
I don't know.
Yeah, I like Max a lot, actually.
Yeah.
I know everyone hates on Zasloff, but I actually think I like
They got good movies.
Yeah.
That's not a reason not to watch Max because you don't like David Zaslav.
Well, yeah.
All right, Bailey Lipschultz, thank you so much. We've got much more coming up. Andrew Slimmon of Morgan Stanley joins us next. This is The Close on Bloomberg.
I remain negative on equities here. I think, we can get all the way down, but at that point, kind of like where we are, you're going to be very prone to squeezes. So, I think basically volatility continues for now.
Binky Chadha over at Deutsche Bank kicking us off to the close 50 minutes ago, addressing some of the volatility, which I guess technically is a little bit lighter than what we saw from last week, but it's still elevated. I was looking at it on a historical basis. I mean, you really have to go back to the big spikes we saw in 2020 and back in 2008 during the global financial crisis to see anything like this.
But we have short-term memory, and compared to last week, things are much calmer. And we know volume is definitely down, especially with tomorrow's holiday and the fact that a lot of kids are on spring break right now. So a lot of families are gone as well. You look at the markets, I don't know how much you can really read into any of this. Not that there's a whole lot going on with the S&P 500, unchanged at the moment. But there is a big move in the ETF that tracks Japanese stocks because U.S. Japanese negotiators began trade talks yesterday and remain. The president says that things are going really well on that front.
All right. Well, that's good. If the president says that, it'll be interesting to see once we get some results, Scarlett Fu. We talk about the big movers on the day here. We talked a little bit earlier about the big drag that United Health was having on the Dow Jones Industrial Average. That stock down 23%. The flip side of all that is a healthcare stock is leading the charge in the S&P 500. Eli Lilly up about 15%. And then in the middle of all that, well, a stock that I had kind of forgotten about, Hertz, which had rallied 56% yesterday, now up today, another 42%. Bill Ackman.
Meme stock.
A meme stock. Bill Ackman confirming what we had already kind of known, which is that Pershing Square has taken a 19.8% stake in the company. Ackman confirming that now, saying that this is direct ownership on his part. So the big question is, with almost 20% direct ownership,
what is he going to do?
Exactly. All right, let's get a broader view of the markets here as we march towards the close with 8 minutes to go until those bells. Andrew Slimmon joins us right now. He's Senior Portfolio Manager and Head of Applied Equity Advisors with Morgan Stanley Investment Management. So, Andrew, I'm assuming that you got a little bit of sleep this week relative to last week. When we come back to work on Monday, given the holiday on Friday, is there a sense here that this market is ready to reset? Because we've got a ton of earnings, a ton of economic data, and of course, a lot of loose ends in Washington when it comes to trade deals.
You know, I wish I had a perfect answer for you, Romaine, but, the truth is, I don't think anyone knows. The reason why I say that is because the narrative is being dictated by the White House. And unless you have a bat phone in the White House, you don't know. A normal pattern, I will say this, a normal pattern is after a big decline on high volatility, on the VIX goes through the roof, you have a significant rally, what we've seen, and then the VIX kind of comes down, the volatility comes down, but the market tends to bleed lower. That's a W bottom where you can have a new low slightly below the previous low. That's a W, but that doesn't happen all the time. Sometimes you have V's, like in 2018, where the market had a low and went straight up. So, it's very, very hard to predict short term the pattern. But to your point on the VIX, when it has breached that 50 level in the past, if you look at the times it's breached that 50 level, well, the returns out 1 year have always been positive. Because it is maximum uncertainty. One of the things that gives me comfort is there was a lot of optimism towards equities at the beginning of the year. And that's been washed away. It's been replaced by fear. And I said at the beginning of the year, I said, the optimism side of the boat is getting awfully crowded. And now that's not the case. So I think the setup is actually better for equities than it was at the beginning of the year.
Well, that's what I'm curious about, too. I mean, we're still sitting on a 15% drawdown on the S&P 500. Binky Chadha at Deutsche Bank earlier today said, look, if you do believe that some of the noise and turmoil is transitory, if you will, meaning that it'll subside, if not this year, maybe into next year, if you're a long-term investor, I mean, there are some stocks out there that you've never really seen multiples this low, at least not in the last decade.
Well, I mean, look. It's intuitively we know this, emotionally we forget this, which is when the uncertainty is high, and there's data that supports this, when the business uncertainty is high, we don't know what's happening and so forth, the returns for equities is far better than when the business uncertainty index is low, because the market responds to the second derivative, the rate of change. And if the uncertainty is very high, it can get better. If the uncertainty is low, it can get worse. In other words, there's a lot of uncertainty already embedded in stock prices, but that doesn't tell you what's going to happen in the next 30 days. You know that, Romaine. That's why I don't know. I just know the setup is better because there's a lot of fear and a lot of uncertainty, and a lot of stock prices reflect it. To your point.
So, Andrew, you say you don't know, but you think that there are some opportunities out there. What are you doing? What adjustments have you made, given that you still believe that there could be more room for prices to fall, given all the uncertainty?
Yeah. Well, look, number one, I think you have to take advantage in terms of pure allocation when you get big drawdowns. So we sent out a note last Tuesday to our investors saying, hey, if you've got cash and you've been waiting for your opportunity, the market's down 15%. Now, I didn't know Trump was going to send out a 90-day pause the next day, but I said, you got to take advantage. So I think from an allocation standpoint, you have to take advantage of these bigger drawdowns if you're looking for timing to get invested. But having said that, I am very wary of making broad readjustments to allocations because, frankly, it can all change overnight. You just don't know whether that's sector in the U.S. or globally. I will say this. We have a big overweighting in financials. And financials were outperforming on a relative basis till the market really got close to that down 20% level. Because historically, when you get down to 20%, that's when it's more likely a recession is around the corner. And that's when credit spreads have a problem. That's what we started to see last Monday and Tuesday. And that's when the president pivoted. So it gives me comfort with a big overweight in financials because I think what he told us is, I think he's for tariffs, but he's not for a recession.
All right, Andrew, got to leave it there. Always a great conversation. Andrew Slimmon, have a wonderful weekend. Senior Portfolio Manager, Head of Applied Equity Advisors at Morgan Stanley Investment Management. Counting us down to those closing bells, Scarlett. Less than 3 minutes until we get there.
I really liked his comment. He's for tariffs, but not for recession. The problem is that one leads to another, according to a lot of economists. So how do you reconcile that?
I know. I kind of wanted to continue that conversation for another 10 minutes because Andrew's always a good on that level. But it gets to this idea, and he kind of gets to this idea that no one really knows, right? Unless you are in the Oval Office and have access to the most important person in the world right now, you just don't know.
You can only operate on what you do know, and that comes down to company fundamentals and how they manage their cash flow.
All right, stocks fading a little bit into the close here. The S&P holding into the green, as is the Russell 2000. The VIX tamped down right around 30 as we break down all of today's market action, starting right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic here with Scarlett Fu. We're taking you through that closing bell. A global simulcast. It starts now. Carol Massar is still here 4 straight days in a row. Tim Stenovic by her side as we welcome our audiences across all of our Bloomberg platforms here on a holiday-shortened week. Carol Massar with stocks not really doing much of anything. We'll just call it unchanged on the day for the benchmark S&P.
It feels like finally investors in the market got the message that it is a holiday-shortened week and we can take a breather. But I do think, again, we're kind of waiting for what is next. But we're also let's not forget, we're in the middle of earnings season. We've got a big one coming after the close. We're talking about Netflix.
Yeah, the Dow taking an outsized hit as a result of United Health shares just cratering today. But the S&P 500, it was as high as 1% earlier in the session. It was as low as 0.4%. But as you said, really doing not a whole much of anything right now.
Yields are moving higher, although, even with them moving higher, it's still a long way off from where it was at the peak of last week. So we kind of head into this weekend breathing a deep sigh of relief, waiting to see whether there are any headlines tomorrow or Saturday, especially after today's, I was going to say Tweet Fest, but Twitter,
no,
that brand no longer exists.
No headlines can come on Friday or Saturday or Sunday.
Do you think?
No. We're on vacation.
Not from this president.
Long weekend.
Long weekend here. I mean, we talk about this idea of whether investors are truly looking for bargains. Andrew Slimmon at Morgan Stanley Investment talked about this just a few minutes ago on the Bloomberg Network. Look, we're still at a 15% drawdown on the S&P 500. So if you believe there is some long-term optimistic story for the U.S., maybe you do take advantage of these dips, like some of the ones that we've seen over the last few days. Here are the numbers on the day as we wait for those Netflix earnings to cross the wire any moment now. A Dow Jones Industrial average lower by about 1.3% on the day, and that's going to be a drop of about 3% over the 4-day week. The S&P higher by about 0.1% on the day. The NASDAQ Composite and the NASDAQ 100, we'll just call it unchanged on the day, though a slight tilt to the downside. In your bright spots today, the Russell 2000 up 0.9%. Dow Transport's up 2.4.
All right, folks, as S&P 500. Most names in the index actually higher today. 384, Scarlett, to the upside, yet 118 to the downside.
All right, and a quick check on the IMAP, the 11 sectors in the S&P 500. You have 8 in the green, 3 in the red. The decliners are tech, healthcare, and communication services. Leading the gains are energy, consumer staples, and real estate investment trusts.
All right, quick, guys. As we wait Netflix, Eli Lilly, one of the big gainers today, up about 14.5%. That after it showed its experimental weight loss pill worked, as well as the Ozempic shot, bringing it closer, one step closer to developing a needle-free alternative. So big outperformer. Got to mention Hertz after a 56% record gain yesterday. Up another 44% in today's session, just crossing the Bloomberg moments ago. Bill Ackman confirming that 19.8% stake in the company.
All right, Netflix crossing the wire right now. The company basically saying that in its fiscal first quarter, EPS did come in at $6.61 a share. That's a beat. The street was looking for $5.68. Revenue, $10.54 billion, pretty much in line with street estimates. Here's your guidance for the fiscal second quarter. Revenue tracking above a midpoint of its 2025 forecast range. Those are the exact words of the company here. The revenue number, $11.04 billion. The street on average was looking for $10.88, so that would actually be a beat for the full year on the revenue side. The company providing a range, $43.5 billion to $44.5 billion. The street on average was looking for $44.33 billion, Scarlett. So at least on the top and bottom line, it does look like a beat on both what happened in the most recent quarter and their guidance for the current quarter and the current year.
And remember, this is a stock that's done tremendously well. So far this year, it's up almost 10%, beating the broader market and the Magnificent Seven, although it's not a member of the Mag 7. In terms of other things it says about its outlook, it still sees its full year operating margin at about 29%, just below the consensus estimate of 29.2%. And it still sees full year free cash flow at about $8 billion. 88 would be a huge number, $8 billion, when analysts were looking for about $8.5 billion. And Tim, of course, this is a company that is no longer providing any subscriber growth numbers. It wants to get away from that and really put the focus on revenue growth, particularly in things like its advertising business.
Yeah, and trying to squeeze as much money from customers that exist already via advertising and raising prices. What you said, Scarlett, about not changing its guidance, they call that out really at the top. That's a pretty big deal given what we've heard from other companies. And look, this is a company that is relatively safe from tariffs, but I guess there is also the concern that if consumers are going to pull back, perhaps they would pull back on a service such as Netflix. You said they're not providing subscriber data. That's certainly true. What they are providing, though, are numbers when it comes to content. They say that the third most popular English language series ever, Adolescence, came in at 124 million views. And there's just this list of content, a list of shows and movies that show how many people are watching. I mean, if you remember Netflix, this is such a far cry from what it used to do with holding that data so close to it before it offered advertising.
Well, that's what I'm curious about, too. I mean, I know everyone's upset that they're not going to provide the actual subscriber numbers, but I think the fact that now they are providing more details on the actual views of these particular programs, and I know some of those numbers are a little sketchy, but the point is that we can now actually get a better sense of which programs are doing better than others.
Hey, just looking at the press release here, talking about monetization, they say as we deliver more value to members, we refine our plans and pricing to improve monetization to drive investment in future service improvements. They say recent pricing adjustments that they made in large markets, so they're talking about the U.S., U.K., and Argentina, have performed in line with expectations. And they say today we're adjusting prices in France, which they already factored into their 2025 guidance. And they say they continue to make progress building out their ads business. We know that they have incorporated that into an ad-based model as well.
I thought it was interesting, too. I mean, we were talking the last couple of quarters about that push into live events. They talk about now how they basically have WWE 52 weeks out of the year. They also talk about some of the additional expansions that they're making in live sports and other live events like stand-up. And I do wonder if that becomes a little bit more of the core of what this company becomes.
I think it does. I mean, even at the top of this statement, Romaine, they say that the live offering with WWE Raw has been on our global top 10 list every single week. So it looks like that customers, that subscribers, it's really resonating with them. I mean, it was just a few years ago that analysts were saying, no, Netflix is never going to do anything live. They're all about everything on demand when you want to watch it.
They also say they would never do advertising, an advertising and they moved into that.
Exactly.
But to your point, Tim, too, I mean, they also, I didn't watch the Taylor Serrano boxing match, but according to them, they're basically saying, and that was last July, they're basically saying that was the most watched professional women's sports event in history, in U.S. history. Not necessarily on their platform, U.S. history overall. which says a lot.
It does say a lot.
And some of the other numbers, I mean, you saw, the numbers that you had for adolescents, which you mentioned, 124 million back in action. That was a Cameron Diaz, Jamie Foxx.
That was a good one.
Which actually was.
Season 2 of The Night Agent. I walked by Carol's desk. I walked by Carol's desk, and she's watching The Night Agent season 2 on her phone. She just can't put it down.
I'm not. Hey,
was she holding a glass of wine?
Yeah, well, you better believe it.
We have wine later, by the way, guys.
Hey, their commentary also, they talk about 2025 revenue outlook assumes healthy member growth, higher subscriptions pricing, and a rough doubling of ad revenue, partially offset by currency net of hedging. Keep in mind that we did see a pop in Netflix, went up about 5% earlier in the week on some reporting in the Journal about, some really upbeat projections for this company over the next couple of years. Talking about $1 trillion, I think, streaming revenue or $1 trillion, valuation, right, by 2030. So
that's the medium-term outlook. What intrigued me with this release, and it's going to be such a contrast to all the other companies that report, is in giving its guidance for the full year, they've said there's been no material change to our overall business outlook since our last earnings report. How many companies can say that in April of 2025?
Not a lot.
Exactly. No material change to our overall business outlook.
One thing I am curious about, though, too, I mean, you see there on your screen there, only up about 0.8%. We came in today with the options market predicting a move up and down of maybe about 8%. This is a stock that's normally pretty volatile. And I do wonder if a lot of that upside was already priced in.
I totally agree with you. I was looking at kind of watching, waiting for it to pop at least 1%, if not more.
Yeah.
And so I agree with you. And that's why I think, that 5% gain that we saw earlier in the week, it was up about 1.5% on Monday. So maybe some of that expectation already built it. And it was up another 1% in today's regular session.
Also, the company specifically calling out international expansion and what it's doing outside of the United States, as Lucas Shaw points out in his write-up of the results. A significant portion of the quarterly letter to shareholders talks about programming outside of the U.S., especially in the UK and Mexico.
Sounds like they kind of front-ran themselves, when they gave out their whole 2030 outlook, revenue doubling,
what was that all about?
Tripling their operating income. They're kind of laying out the lay of the land here, and they see a very steady growth trajectory in a way that a lot of companies can. It's a way of flexing.
Yeah, I guess, yeah. And we are talking about a stock that's up 12% just the last couple of weeks alone, outperforming pretty much everything else in its peer group. So,
Squid Game's your favorite, right?
I've never seen it.
I finally
season 1 was great. I didn't watch season 2.
No, Back in Action is his favorite.
Is that a cooking show? I like those competitions, Chopped.
All right.
Top Chef.
What are we going to do with you? Oh, my God. All right. No, it's not a cooking show. All right. That's a wrap. Our cross-platform coverage.
British Baking Company.
Are you done? Our cross-platform on radio, TV, YouTube, Bloomberg Originals. We call it the closing bell.
I think I would do well on the Great British Baking Show.
We call it Romaine Never Stops Talking.
I don't.
Just kidding.
I don't.
Have a good and safe long weekend, everybody. We will see you again on Monday.
And we continue our coverage right here on Bloomberg. Special coverage of those earnings that we just got out of Netflix. A beat in the most recent quarter. Guidance for the current quarter and for the full year also coming in slightly above what the street was looking for. The company making it clear that its long-term plan is still firmly in place, and it does not see, at least at the moment, any disruption from all the turmoil going out there in the broader economy. Peter Supino joins us right now, senior analyst of media and entertainment at Wolfe Research. He's got an outperform rating on the shares and a price target of $1,100. All right, Peter, what jumped out at you? Were you relatively encouraged by what you saw today?
Very encouraged. The second quarter outlook is better than our bullish forecast. And stepping back from the earnings report, this company has won the streaming wars. This company has a broadening array of growth strategies. We think they're defining the future at this point, and the price of the stock is just fine.
What do you make of sort of the push into the ad tier? And I know we don't have sort of all the specific numbers here, but they kind of seem to be hedging the idea that they're still doing well with just normal paid subscribers. But clearly the ad tier is going to become a much bigger player in this business over the years.
Streaming is ultimately a consumer service. And in consumer services, consumer products, segmentation is everything. Advertising supported video is a tale as old as time, or a product as old as time. And Netflix, absence from it was a quirk of the companies that had run its course. And so they're absolutely correct to be building this ad tier. We think advertising revenue will exceed $2 billion this year. And the company let everybody know a few days ago, whether intentionally or not, that it envisions $10 billion of advertising over the long run. there's about $60 billion of long-form video advertising in the United States. So it's a really ambitious but still plausible target. The company just turned on its own ad server this month, and so they'll be better able to target advertising starting just about now.
Do you think we'll ever get to the point where Netflix is going to force everyone into an ad tier, Peter?
I doubt it. I think that so long as customers want to pay a premium to experience Netflix without ads, Netflix will be happy to charge them for the privilege. Nobody will escape advertising on sports, of course.
No, that would be just counterintuitive in every single way, given that it's appointment viewing. Peter, you mentioned how it's clear that Netflix has won the streaming wars. Who or what is its biggest competition now? In the past, it said Sleep was a competitor. It's also identified YouTube as a competitor. Who or what does it compete against now?
Yeah, as you alluded to, Netflix talks about YouTube as its primary competitor. And in looking at the streaming engagement data, YouTube is getting about 50% more engagement every month than Netflix is. And in my household, the younger members of the household watch a lot more YouTube than Netflix. And that's something that Netflix has to worry about it when they think about the world on a 10-year basis. Over the next 2 years, that doesn't matter at all. The two can coexist and thrive side by side. But this is a company that has always thought very strategically and managed the short term and the long term together. And a company in that mindset will certainly be thinking about ways to evolve its service to expand the segments of the market that it addresses for the long run.
Does that strategy extend to one day platforming user-created content as opposed to professionally made content? Because that's what YouTube has that Netflix doesn't.
So they're certainly exploring it. They've almost said as much. It's a really tricky product for them to address in the near term or to provide because Netflix is all about premium and YouTube is all about mass market. And so whatever Netflix might do someday in quote unquote user-generated content has to be done in a very premium way. There are recent examples of content creators who are sort of going premium. The deal between Mr. Beast and Amazon is the one that gets the most attention. We were in Los Angeles last month visiting with management teams and a group of clients and found broadening interest in this concept, but it's still very much a whiteboard area of content development.
All right, Peter. So in about, 30 minutes or so, we're going to get the start of that conference call, if you want to call it that. Obviously, it's only one person asking questions. But, I mean, if you had a chance to ask a question of Sarandos or Peters, I mean, what would you ask?
My question is about content spending. I view the Netflix flywheel as beginning with content spending and, of course, doing it productively. And I want to know how much they think they can spend over the long run. Because if they can do it productively, it'll just drive more and more growth and reinforce their competitive advantage. So I'm rooting for more content spending, even if it's at the expense of operating leverage in the next few years, because this is the time for them to press their advantage.
All right, good stuff. Peter Supino, senior analyst over at Wolfe Research, giving us his take on Netflix. And you can see right now the shares up about 2.6% in after-hours trading. And Romain, as you mentioned, this is a stock that tends to move big on earnings day, right after its earnings announcement. And this time the gain is relatively muted. Yeah, and there was a somewhat of a run-up prior to today's earnings report, unlike what we saw in a couple of the other quarters. And of course, once they talk on the conference call, or if we're calling that conference interview, if you will, maybe that tends to provide a little bit more of a boost to the stock. Earnings presentation.
And we should point out, too, of course, tomorrow's a holiday, so any sort of reaction in the cash market would have to wait until Monday.
Yeah, but once again, let's just reiterate that they're not going to come out with subscriber growth numbers, the number that everyone used to fixate on. So there's going to be a lot of probing on the revenue forecast that they do offer.
But you know what I think might actually be more illuminating, just if you ask me, is when we start to get the earnings out of Warner Brothers, out of Paramount, out of Disney, so we can have more of a comparison as to how those streaming services are doing relative to Netflix. Because as Peter points out, I mean, they've basically won the streaming wars, and I think that will probably be ratified once we see the earnings reports from those other
That first mover advantage has really paid off for Netflix. All right, coming up, Ross Bennis of Emarketer helps us break down all these Netflix results. We'll continue our coverage of Netflix, currently adding to its gains, now at 3.6% higher in after-hours trade. This is The Close on Bloomberg. right, we're looking at shares of Netflix moving higher in after hours trading after reporting earnings moments ago. It boosted its profit forecast. A recent price increase helped support its first quarter profit, and it has maintained its full year profit forecast, saying it doesn't see any big disruptions to its outlook. Certainly an outlier in this kind of environment. This, by the way, marks the first time that Netflix is no longer reporting quarterly subscriber additions, which our next guest says was done before low growth would be noticed due to restrictions on password sharing. Joining us now is Ross Benish. He is Emarketer's senior analyst who covers TV and streaming. Ross, it's good to speak with you. So talk to us a little bit more about password sharing, because certainly that did affect the numbers initially and lead to an increase in those subscribers joining the advertising tier. Have we seen the full benefits of the password sharing moving to the ad tier, or is that still kind of underneath the numbers?
We've seen most of the benefits at this point. So prior to them restricting password sharing, Netflix's subscriber growth had stalled. They already had hundreds of millions of subscribers around the world. There wasn't a lot of space to add people. Now suddenly you have freeloaders who need to start paying for their own plans, which gave them, huge boost over that first full year after they implemented the restrictions. But now that they've been around a while, it's harder to find new people to add, which is why I think they got ahead of the game to stop reporting that metric before they would start reporting flat subscribers or even losses.
When you look at subscriber growth, which region seems to have the most promise for Netflix? Which geographic region?
Well, APAC has a lot of promise for Netflix. They're already pretty saturated in the US and even in parts of Europe, but they have room for expansion in APAC. Of course, though, they're not in China like any other US media company.
So, Ross, when we talk about this idea of sort of where eyeballs are going and the idea, more importantly, of what people are willing to pay for, there's been a lot of talk that a lot of people are looking at their sort of suite of streaming services and making decisions about which ones to keep and which ones to chuck here. Are we seeing movement in there? Is that just anecdotal? But is it showing up in the numbers?
There is some churn, and there are services that are reporting lower figures. Before Warner Brothers Discovery had their own password sharing, Max subscribers are pretty flat. Disney Plus has lost subscribers. So people are becoming more judicious about how much they will spend on entertainment, especially as the prices have gone up. And it seems like we're about to enter a recession. But one thing Netflix has going for them is they have very low cancellation rates. It's almost like a utility bill. If you look at the share of total subscribers of Netflix that cancel in a given month, it's like a third of what you would see from something like Apple TV Plus or Paramount Plus.
There's been a lot of talk that, obviously Netflix having that first mover advantage, Netflix, if you will, of all the hyperbole, has sort of won the streaming wars. But we have seen some pushback, whether it's from Disney or Max, or even some of the more traditional cable, linear type TV services. And that's kind of this idea of going back to the bundle. I mean, Max seems to be really indicative of that, how it's just kind of created this broad ecosystem. Is that a way to compete with Netflix?
That is a way to compete with Netflix, but with bundling, you have to be careful who you're partnering with, and you don't want to partner with someone that has exact audience overlap as yourself, because then you just cannibalize your own audience. So that specific bundle you're referring to with Max and Hulu and Disney Plus worked quite well because Max's viewers did not overlap with Disney Plus viewers that well. Like Max, it's HBO. It appeals to adults. Disney Plus is very much like a family and kid-oriented service. So there was a gap there where one service didn't have the other service's viewers. They could team up and expand their audience. But that use case doesn't apply universally across the board, because if you do it with a service that's very similar to yourself, you wouldn't gain much and you'd have more to lose.
Yeah.
So when you look at Netflix over the last couple of years, it feels like the themes here in terms of what's driving growth in 2024 is subscriber growth, now that they're no longer giving those numbers out. In 2025, it's really price increases. And then looking ahead to 2026, it'll be the advertising tier. Ideally, what kind of breakdown does Netflix want for those who are paying just the premium tier versus the ad-sponsored tier?
Well, I'm not sure what sort of mix they ultimately want, but I can tell you where that mix is right now, and it's that 3/4 of viewers are still on the ad-free plan. So, only about a fourth of viewers are on the ad-supported plan, and they're going to try to goose those numbers up, but they're not in a rush to do it in a very aggressive way. The ad-free plan is still very lucrative for Netflix. They still receive about 15 times more revenue in subscriptions than they do from advertising. And, they disrupted the TV industry with that ad-free plan. They don't want to give it away because that's what so many subscribers are paying for and what they think of when they think of Netflix.
All right, Ross, got to leave it there. Ross Banish, Emarketer senior analyst, a closer look here at those Netflix earnings and a closer look at the subscriber side of the business, upside of the business that might actually be supported by that big push into the world of live events and sports. Of course, we know that Netflix has become the exclusive home of WWE's flagship wrestling program, Monday Night Raw. The move building on its expansion into live sports, which also included the NFL Christmas Day games and that, well, somewhat glitchy Jake Paul-Mike Tyson fight. Dave Lee of Bloomberg Opinion joins us to talk a little bit more about this push into live sports. Obviously, it seems smart. I mean, we've seen the numbers on some of these, and clearly people are watching them. You think that this is kind of where they go?
Well, look, for the longest time, Netflix said no interest in live sports. They also said no interest in advertising. So you can see how that's changed over time. I think, right now the driver of subscribers isn't sport, right? It's things like Adolescence, the big TV show back in the UK. It's still that sort of traditional Netflix product. However, live sports is an extra dimension that they can use to build on what they've got. So live sports, if you have a show like the WWE, which runs throughout the whole year, that's very sticky for subscriber growth. And we're just talking about how Netflix is performing strongly there. And also, much of their user growth is going to come from global markets. And so when Netflix goes out and gets the FIFA Women's World Cup for the next 2 tournaments, that's good for international.
Do they need exclusivity with some of these? Because I feel like WWE worked for a couple of reasons. A, they got the whole, at least with the main event, they got the whole package. On top of that, you had a customer base that was rapidly loyal to it. But when I see like one-off football games or one-off, soccer events like this, is that enough to really get people there, or are people just going to sign up for that one day just to watch that game?
I mean, that is the risk. And we know that Netflix, is looking at these sort of season-long deals. One of the concerns they have is they don't think those deals are very good value for money. They're trying to pull the price down from some of the linear TV packages because Netflix say, well, if you partner with us, you get the benefit of being on Netflix, which is a bigger global footprint. They have this sort of tech stack that they can add with additional programming. And one of the things from the wrestling that was interesting is that viewership of the event after the live program was up 25% compared to what they were doing previously. So they have these added benefits that traditional broadcasters can't bring. But right now, every indication they don't think that the traditional packages are good value for money, but maybe they can talk them round.
The other thing that's interesting when we talk about Netflix and sports is that sports leagues seem to create content specifically for Netflix. Like Christmas Day games didn't used to be a thing, and now it is. Netflix offers it. The NBA did not used to have an in-season tournament, but there were talks about how Netflix was going to perhaps host that on its platform as well. So like different sports leagues will work with Netflix in a way that, maybe the other networks, the other broadcasters would just kind of have terms dictated to them.
Yeah, and also those networks didn't necessarily have the venue for that additional programming to exist in a way that would be seen by millions of people. I mean, one of the sports that Netflix has had a lot of coverage on, if not the live event itself, has been Formula One. That's been very popular. I think one rights deal to look out for in the near future will be the UFC, similar to the wrestling in some respect, but without the sort of drawback of it being a bit of a pantomime, right, like wrestling is. UFC, those rights are up. Netflix said
it's real to me. It's real to me.
I know you're a big fan, but no, but the UFC is slightly more
Romain is very innocent
competitive.
That way. What about esports?
Who's your favorite UK wrestler? Do you have UK wrestlers?
Is there a UK wrestler?
Well, there's like Nigel Ferguson.
There was the guy, William Regal was my...
William Regal.
It's a blast from the past from my teenage years. Yeah, he was very English, but he...
Dave, let me ask you, what about Netflix and esports? Is that something that you think that we might get to see more of, or is that an area that would make sense for Netflix to venture into?
I think what's very difficult for Netflix on that is that when you look at its... And you were talking earlier in the program about YouTube as a threat for sort of youth audiences. YouTube and Twitch, which is owned by Amazon, they are the places where people who love esports expect to see esports. Now, maybe that market will mature in the way that we've seen in countries like South Korea, but I think we're a little way from that being something that Netflix would really pour.
Well, but and to that point, though, too, we didn't really get a chance to talk about it. I mean, they also have to deal with the technological issues. We saw what happened with the Jake Paul fight, even with that Christmas Day game last week. I mean, with esports, I mean, just having a teenage boy who's into that stuff, I mean, it's much more interactive. I mean, I would just assume the amount of data use that you need for that, because it's much more interactive in terms of with the viewers being able to chime in. So they've got to be able to get that part of it technologically on point.
I mean, absolutely. Of course, Netflix is the leader of this, right?
Yeah,
I mean, if anyone's going to solve that issue, it's going to be Netflix. The Christmas Day NFL games, glitchy a little bit here.
Yeah.
The Beyonce bit didn't. There's a the buffering
that was,
maybe in certain homes,
and I'm pretty sure Heidi popped up at some point as well. Dave, I'm sorry, I monopolize all our time, so we're out of it now. Scarlett, take us out.
WWE is real, Romain. All right.
We can keep talking after the break.
We'll wrestle after.
Dave Lee of Bloomberg Opinion, always a pleasure. Thank you so much for joining us today. All right, coming up, we're going to continue to keep an eye on these Netflix results. We're going to break down the advertising side with Mark Douglas of Mountain next, as the stock extends its advance, and after hours trading now up 4.5%. This is The Close on Bloomberg. All right, we're looking at shares of Netflix moving higher in after-hours trading. Its second quarter revenue forecast did top analyst estimates. For more on what we can expect from the conference call and really how the stock is positioned right now, let's bring in Geetha Ranganathan of Bloomberg Intelligence, because she has written, quote, Netflix and Spotify are safe havens amid the tariff and economic turmoil. As a digital service provider, Netflix is insulated from the escalating tariff-related chaos. Geetha joins us now. So Geetha, Netflix is in this enviable position of not being directly affected by the tariffs. And if anything, if people do trade down from their Netflix subscription, they offer a cheaper tier, an advertising-supported tier, which is something that they want to grow pretty aggressively. That sets Netflix up pretty well, doesn't it?
Yeah, absolutely. It's a really, really defensible model, Scarlett, as you pointed out. It's mainly subscription-based, very limited exposure to advertising. And again, if people are cutting back on their budgets, you're absolutely right that they can trade down to the model, which helps them actually build out their subscription business, their advertising business. But even then, what we've generally seen in periods of, recession, and if there's an economic downturn, we've generally seen actually people gravitate more towards watching, TV, more towards watching all of these streaming platforms. So we don't necessarily expect people to trade down, just kind of given some of Netflix's track record through COVID and through other recessionary periods.
How much of this is dependent on the content flow, Geetha, or is there just now so much out there it doesn't matter? New content, I should say.
It totally depends on content, and for Netflix, content is absolutely the biggest differentiator, Romain. So it has been, definitely we've seen that over the past many quarters, and we are going to continue to see that in 2025. In fact, many times management has said that 2025 is their best content year. They've called it an embarrassment of riches because they have three of their biggest shows yet to come on the service. So we have another season of Squid Game, we have another season of Stranger Things, and another season of Wednesday, which typically have been their biggest shows. And they continue to produce, all of these different sleeper hits. So, you had Adolescence, which was absolutely huge in the first quarter, Night Agent. So, lots of content across many different genres, across, even nonfiction content really performing well for them.
So what's interesting here, Geetha, is that for a while, everyone licensed their content to Netflix. And then they realized that they needed to build up their own library as they were building out their own streaming services. So then they hoarded their content. Are they back to licensing their content to Netflix?
They are back to licensing. And, this is why we are seeing Netflix actually get so much more operating leverage in the model. So now we're seeing Netflix kind of really achieving this very, very balanced mix, I would say, of content, maybe, 50-50 or maybe even 60% originals, 40% licensed. But what licensed content helps Netflix do is kind of really keep their costs down. And this is why we are seeing operating margin the way it is. Operating margin expand 600 basis points last year. And the way that they've guided up to 2030 is we're thinking it goes up to, 40%.
Geetha Ranganathan over at Bloomberg Intelligence. A closer breakdown of those earnings out of Netflix as we await for that so-called conference call taking place in about 10 minutes time. Meanwhile, we continue the conversation right here in Studio 2 with a closer look at the ad side of the business. The Wall Street Journal reporting just a little bit earlier this week that Netflix aims to double its revenue and triple its operating income by 2030, fueled by both user growth and advertising revenue. Mark Douglas knows a lot about the ad side of the business. He's the founder and CEO of the ad tech firm Mountain. Great to have you, Mark.
Thanks.
Well, I should point out, Netflix now also is an ad tech firm. I mean, they finally rolled out their first party ad tech firm in April, at the beginning of April this month. I'm losing track here. Talk to me about how that's going to work with them. Is this going to make it more efficient for them to build out this ad tier?
Yeah, I mean, it's going to take a bit of time. I think Netflix is still learning the advertising business. They kind of taken it from a very big brand, big relationship approach where the industry has gone more towards democratization. But the key thing with Netflix is half of the new subscribers, they reported in previous quarters, are buying the ad-supported tier, but they're not monetizing them that well yet. So remember, like password sharing, they had this big backlog, and then all of a sudden they kind of tightened it a bit, and it produced tons of new subscriptions.
Right.
That's going to happen in the ad tier. So they keep signing up people with ad-supported. They're not yet showing them many ads, but when they do, it's going to unlock a lot of additional revenue, and it's going to be nearly purely profitable.
So that means more ads.
Yeah, more ads, and more importantly, probably 90% gross margins.
Do you think that they're going to hold the line on the subscription side of the business and keeping those top tiers ad free?
Yeah, I think people might downgrade the subscription, but when they go down, so the most expensive tier on Netflix costs 68% more, or the other way to think about it, the least expensive 68% less.
Yeah.
So people may go down, but then the ad tier will generate the incremental revenue for them. And I always think the first thing you get is the last thing you cancel. So I don't see people canceling Netflix if they want to save money, and people want entertainment.
We're gonna cancel.
Yeah. And it's the first thing most people turn on when they turn on their TV. I think Netflix is, if anything, they should still release subscriber numbers and show how no one's canceling.
Right. No, people want escapism, and Netflix certainly offers that. Does Netflix need to innovate the ad experience? Because I think about Hulu, and I have the cheap version of Hulu where I have to watch the commercials, and it's the same commercials every single commercial break.
Yeah.
And it gets repeated over and over again, and it's annoying. I mute it and I turn away, I go to the bathroom. Is that something Netflix can improve upon, or do they not need to because people recognize that they're getting a good deal?
Yeah, I think it is something the whole industry needs to improve upon, and I think they are very focused on it, and it happens by just opening up that market to more and more advertisers and not just relying on just the top tier largest ones. Right now, that is what Netflix is doing, but I think they'll change that over the next 2 years or so.
So I'm looking at the press release right now, and I did a search for a subscriber. No mention of it anywhere. If they were to say something about it, what do you think they would say about subscribers?
In terms of this last quarter?
In terms of last quarter, in terms of how they're thinking about it going forward?
Yeah, I think it's obvious. I think they did a female boxing event, highest rated female sports event in history of television.
And there's going to be a repeat, right?
Yeah, there's going to be a repeat.
Months,
They did Mike Tyson and Jake Paul. They did NFL. All of that had to contribute to subscriber growth. WWE. So I think they're very strict. They've taken sports that probably wouldn't have been like the number one show, and they've turned it into the number one show, and probably saved themselves a lot of money versus like trying to compete for NFL rights for an entire season or something like that. They're very smart about it.
Mark, I have to ask you just about the broader ad landscape, particularly given if you believe what a lot of folks on Wall Street think, that maybe we are headed for economic downtimes. And I know in the past, and this is probably old school, when I started my career, the advertising industry was always kind of an economic barometer, that as the economy sort of slipped, so too did ad spending. Are you seeing any sort of weakness in that area?
Well, that tends to happen on brand advertising because the big brands view that as a cost, and it's kind of the first thing that gets cut. But if you look at Google and Meta, if you just look historically at recessions, things like that, they're basically recession-proof. And so I think...
Does the complexion of the ads change, meaning the types of folks that are coming to the ad platform?
Well, you get more of that performance advertising, that direct response ad. I mean, Google, like you don't go to Google to buy ads, you go to buy traffic to your brand.
Yeah, exactly.
And when you're buying revenue, and so when you're in a recession, you want more revenue.
That's a good point.
So they tend to do well. The brand agency side of the business, it could be affected, but we'll see.
We're lucky we have you here because I also want to get your take on the ruling from the federal judge on Alphabet, the Google unit illegally monopolizing some online ad tech markets. And of course, this did give ad tech stocks a big, big lift. How do you see this resolving, maybe years down the road, because nothing's going to happen immediately? This is something that, Alphabet, Google has the time to wait out.
Yeah, well, I don't think they want to wait it out. I think this is almost a dream scenario for Google.
Really?
Yeah, because if you're going to focus on monopoly power, it's a nice misdirection to focus on the part of the business they care the least about. And so it's great for, like a trade desk or something like that. But I think for Google, it's like, great, let's talk about that. It's like, you put bread and olive oil on tables to bread without the olive oil. Like, yeah, take that away. I'm still good.
All right.
And so I think it's a dream scenario for them to get everyone focused on that and not their search business.
Oh, okay. All right. So maybe we're making a little bit too much of this.
Yeah.
Now,
if they go after search, now that's a big deal.
I do have to ask you about your own business, Mountain.
Yeah.
It's done well. There are a lot of talk about you going public. How are things right now?
Well, we filed an S1, so
I saw
legally not allowed to say.
Okay.
There are rules with the SEC I can't say, but
and I don't want to get you in trouble.
Yeah.
How are you feeling about market conditions right now?
Like I said, performance advertising tends to do well in a recession.
All right, Mark Douglas, appreciate you joining us. Mark is founder and CEO of ad tech firm Mountain, which, as he just reminded us, did file an S1. So at some point, they're going to go public.
Hopefully, and we'll see. The idea of whether the capital markets do open up. We were talking earlier today about that big three-way deal, FIS and WorldPay and GTCR, and the idea that deals are getting done. They're just going to be a little bit more strategic rather than the other way around.
All right, let's take a look at how markets closed on the day as well, because at the end of it, there was not a whole lot to write home about. The S&P 500 gaining 0.1%. But what's notable here is what we saw in the healthcare space. You had pointed out that Eli Lilly did incredibly well, but then you've got United Health, which plunged. And so as a result, that dragged down what had been seen as a safe sector within the market.
And I think this is an interesting setup into next week. We really start to get into the heat of earnings season. More than 100 in S&P companies scheduled to report next week. We have a lot more coming up here on the show, but I'm told we need to go down to Washington, D.C. right now, where the President of the United States, Donald Trump, speaking in the Oval Office. Let's take a listen.
And I've been going through hell for years.
Thanks, Mark.
And somebody overheard that statement, and they said, oh, that happened to me too. Another one overheard, oh, that happened to me too. It was the Biden people, and they had 7 or 8 of them. We're going to be reporting it very soon. I said, this has to be reported. These are ministers, pastors, evangelicals. They were targeted by the Biden administration, which was a disgraceful administration. Well, I was targeted more than anybody in history. I think you probably know that. I hope you admit it, but you might not. But I was targeted more than anybody in history. But it was interesting because one pastor told me, and another one heard it, oh, me too, and me too, me too, me too. All of a sudden, they're all, and one of them spent all of his money, everything he had on lawyers, for 3 years, he said. It took place almost immediately after the election. After the election, when Biden came in, unfortunately for the country, sadly for the country. So when you ask me that question, I immediately say, let's switch it around to tell you what happened last night. And not only that, we're also finding that many people just having to do with Trump support have gone through hell. And they've used the IRS for purposes of something that's very illegal for them to have to do.
What are you trying to
It's a very illegal, it's a very, very illegal thing to do, what they did. And I think it's such a shame. That was long what?
If that was wrong, why are you considering changing the tax status of Harvard?
Because I think Harvard's a disgrace. I think what they did was a disgrace. They're obviously anti-Semitic, and all of a sudden they're starting to behave. But when you see what they were saying, what they were doing, when you see the way they took care of events, when you watch that woman, that horrendous president that ruined the image of Harvard, maybe permanently, in Congress, in the halls of Congress, when you take a look at what happened there, it was horrific. And, I've looked at a lot having to do with it. I'm not involved in it. It's being handled by lawyers. I read about it just like you did. But tax-exempt status, I mean, it's a privilege. It's really a privilege. And it's been abused by a lot more than Harvard, too, by a lot more than Harvard. So we'll see how that all works out. I don't think they've made a final ruling. I don't believe they've made a final ruling, but it's It's something that these schools really have to be very, very careful with. Very anti-Semitic when you take a look, whether it's Columbia, Harvard, Princeton. I don't know what's going on, but when you see how badly they've acted, and in other ways also, so we'll be looking at it very strongly.
Mr. President, on that subject, on the tax-exempt status subject, what are the other groups you'd like to see that status removed from? Could we expect an executive?
Well, we'll be making some statements, but it's a big deal, and they're so rich and so strong, and then they go so bad. They've earned so much by being a member of this country, a member of this group, this beautiful group of people in this country, and then they go and they abuse their power like that. I think it's very sad.
Are we talking about immigrant rights groups, environmental rights groups?
Could be. I mean, look, environmental. I have a group named CREW. You ever hear of it? I think it's CREW. And they have a guy that heads CREW. It's supposed to be a charitable organization. The only charity they had is going after Donald Trump. So we're looking at that. We're looking at a lot of things. But if you take a look at CREW, what they've done, and I think it was a very big abuse, but we're going to be finding out pretty soon.
Can you explain the disconnect between your conversations with President Xi, when those potentially could happen and why they haven't happened yet?
Well, you don't know whether or not they've happened.
That's my question.
Yeah, I mean, I've never said whether or not they've happened, but I have a very good relationship with President Xi, and I think it's going to continue. And I would say they have reached out a number of times.
Xi or they?
Well, the same. I view it very similar. It would be top levels of China. And if you knew him, you would know that if they reached out, he knew exactly. He knew everything about it. He runs it very tight, very strong, very smart. And yeah, we're talking to China.
So they've reached out in recent days or recent weeks?
Excuse me?
They've reached out since the 145% tariffs?
Oh, yeah, sure. Yeah.
Do you believe
a lot?
Do you believe
a lot all the time? We're talking.
Have you talked directly to President Xi?
I don't want to say that. Yeah. It's just not appropriate.
But you're speaking.
Sorry. Has he called you directly, President Xi, or reached out to try to facilitate a conversation?
Well, you'd think it was pretty obvious that he has, but we will talk about that soon. It's not that important because, honestly, we're going to have a deal. I believe we're going to have a deal with China. And if we don't, we're going to have a deal anyway because we're going to set a certain target, and that's going to be it. You have anything to say about that, Howard?
I think our tariff policy around the world has every country in the world coming in and talking to us. It is incredible. We had country after country in yesterday. We are confident that we will work out something with China, and the president knows what he wants to do, and I think he knows it better than anybody else in the world, and we are confident that this is going to work out well, both for the United States of America. I'm sure he'll work it out with China, but the amount of other countries who are working with us is incredible. And I think it's really going to work for the American farmers, for our ranchers, for our fishermen, for our businesses. The scale of companies coming to America just every day, like even this morning we were talking about Whirlpool, and then we were talking about car companies opening. The scale of factories coming to America is mind-boggling, driven by Donald Trump's tariff policy, which has got the world coming and finally respecting the United States of America.
President Trump, you said
And by the way, there's never been anything like it. We have at least $7 trillion of new businesses coming in. If you go back and look at others, I mean, in years they wouldn't do anything like that. So, and this is in a matter of weeks, so it's been pretty amazing.
You said we're talking, so China and the U.S. are talking on tariffs.
Oh, sure.
Do you believe then that they won't go higher than 125%? We've heard Chinese officials say that. And then, like, what happens if they do go higher? Do we retaliate more?
Well, at a certain point, I don't want them to go higher because at a certain point you make it where people don't buy. So I may not want to go higher, or I may not want to even go up to that level. I may want to go to less because, you know, you want people to buy. And at a certain point, people aren't going to buy. And it's actually up to 145% because you have the 20.
You previously said that you would consider reducing tariffs on China to get a tic-tac deal done. Is that still on the table as of now?
Well, we have a deal for TikTok, but it'll be subject to China, so we'll just delay the deal till this thing works out one way or the other. And I think it's a good deal for China. The TikTok deal is very good. TikTok is good for China, and I think they'd like to see us do a deal, especially the deal that we have pretty much done with some of the best companies in the world.
If they agree to sign the deal, would you take that into consideration?
I think it would be something we discuss because it's a natural. If we're making a deal, I guess we'll spend 5 minutes to talk about TikTok. It wouldn't take very long.
Can you give us a sense of how far along these negotiations are with China? Are they in the early stages, or are you inching closer now to actually making a deal on tariffs?
I think that we will make a deal with China. I think we've had some very good talks, but we will have some very good talks remaining. And, I view it, and some people say, oh, rush. I think we have a lot of time. I think we have plenty of time. But we have very, very good. You saw Japan was here yesterday. We had Italy today. We had a great conversation with the Prime Minister. We've had very good talks yesterday with Mexico. Talking with everybody. The problem is it's only so many hours in the day. I think we're going to make a deal with China. We're going to make a deal with everybody. And if we don't make a deal, we'll just set a target, and we'll live with that, and it'll be fine too.
How much time do you think?
I would think over the next 3 or 4 weeks, I think maybe the whole thing could be concluded. You have to understand, we're a big, if you think of us as a big, beautiful department store before that business was destroyed by the internet. We're a big, beautiful store, and everybody wants a piece of that store. China wants it. Japan wants it, Mexico, Canada, they live off it, those two. Without us, they wouldn't have a country. And everybody wants a piece. And at a certain point, if we don't make a deal, we'll just set a limit. We'll set a tariff, we'll set some parameters, and we'll say, come in and shop. They may not like that, and they may find it, or the market may find it too high, more likely the market, but the market may find it too high, or the country may find it too high. Then they'll come back and say, well, we think this is too high, and we'll negotiate, or they're going to say something else. They're going to say, well, let's see what happens. But they always have a right not to do it. So they can say, well, we don't want it, so we're not going to shop there. We're not going to shop in the store of America. We have something that nobody else has, and that's the American consumer. And I had the most successful 4-year period in the history of this country, and I think we're going to blow it away this time. But there is a little bit of a transition, and we're going to have that little transition, and it's not much of a transition. If you look right now, we're getting 25% on cars, right? We're getting 25% on steel. We're getting 25% on aluminum. We're going to have some other things that we're going to be adding in the not too distant future because we want them to be made here. The medicines, the drugs, pharmaceuticals are going to be done, and computer chips, et cetera, et cetera. And because of that, we have the biggest computer companies in the world coming in from Taiwan and other places, and they're building in Arizona and lots of other places. We're number one in AI by far. We're leading China by a lot, by tremendous amounts. We're going to supply electricity at levels never supplied before. They're going to build their own electric. We're going to let them become a utility, essentially. And it's going to be amazing for the country. They're going to build their own electric plants. We have to double up our electricity to remain number one in AI. We're going to have to double up our electricity take our whole country. We're going to have to double up our electricity. Think of that. And probably even triple it up. And we're going to let them build their own electric plants with their plant that they're building for the AI or whatever they're doing. Never been done before. We're going to get them quick approvals. It's going to be very clean, going to be very nice. And we're going to get them very fast approvals. And people are investing in this country like they've never invested before. Thank you very much, everybody.
Thank you, Press. Thank you, Press. Thank you. We're headed out. Thank you, guys. We're right here. Let's go. Thank you.
And we're watching President Donald Trump there in the Oval Office, a wide-ranging commentary as he signed executive orders Of course, he was asked about the situations going on with tariffs and reiterated the idea that several countries have been lining up to negotiate. He mentioned, of course, Japan being in town, also Giorgia Meloni, who, of course, leads Italy, also being in town today, and says other nations are also lining up as well. He reiterates that the tariffs on steel, aluminum, and cars will continue to take effect, as are the ones on computers and chips. The president also saying, Scarlett, though, he does think that the market may find some of these tariffs too high.
Really? I mean, I think the market reaction kind of indicated that.
Yeah.
But, this is a moving target right now, and we'll see how it all shakes out, as he would say. He did make a number of comments on China as well, which was interesting, which I had not realized, which is that we have a deal. The U.S. has a deal for TikTok, but it's subject to China approving it, and the TikTok deal is good for China. So the fact that there is a deal already in place is something that was new to me. I know that they were talking, but certainly we're waiting to see how that shakes out.
Yeah. We should point out, like, who is that deal with? Because we know that there were several companies interested in it.
And it's gone through various iterations.
He said that. I know some of the reporting conflicts with that we should just point that out. And it's always been known, despite what the president said today, that China ultimately is the one that has to sign off on this. And based on what we know right now, China has not signed off.
Right, and the valuable part of that TikTok deal, of course, is the algorithm, the technology behind it. You can buy the actual brand, but if you don't have access to the technology, then what are you getting?
I think what's interesting, though, too, is the idea that this is potentially going to be used as a bargaining chip or whatever, if you will, in whatever negotiations might take place. I mean, he seemed to allude to the idea that the conversation between China and the U.S., that there was conversations or not. He said that only he's the one who knows that.
Right. Well, he did say we're talking on tariffs when asked to push who's we.
Yeah.
He said she, senior officials are all the same when it comes to who they represent. So obviously more to come on this.
He also talked about, of course, the Nippon Steel deal, also saying that could be a part of the bargaining with regards to any sort of trade deal with Japan. Well, of course, we will keep an eye on that, and you definitely want to stick around for Balance of Power at the top of the hour. They'll have much of deeper coverage into the president's comments. In the meantime, as we close out our show here on this holiday shortened week, we do want to set you up for what to watch over the next few days, and that includes, of course, Good Friday tomorrow. Most global markets will be closed, including both the Treasury and equity markets here in the United States.
Yeah, but there might just be headlines coming out of Washington. So if that happens, we'll be looking to European markets or to futures to see how they react.
Monday, IMF World Bank spring meetings kick off down in Washington. And on Tuesday, earnings really start to kick in with several big names.
Yeah, we've got General Electric, and then we also have a number of defense contractors, Lockheed Martin as well, Verizon, 3M, Tesla, Capital One, so a whole gamut.
Yeah, more than 100 of S&P companies are reporting. It's going to be a nice cross-section, too, of industries, including on Wednesday when we get AT&T, Boeing, IBM, and Texas Instruments. Also that Fed Beige Book. Then on Thursday, economic data, Scarlett.
Yeah, durable goods will be interesting, especially because we do know a lot of companies had been front-running the tariffs. See how that comes out. Existing home sales due out as well. Southwest,
American, some of the companies reporting on Thursday, including Alphabet and Intel, which could sort of be a big one. And then on Friday, we get another read on consumer sentiment.
I mean, University of Michigan comes out with its sentiment read. Everyone's going to look at inflation expectations.
Scarlett and I will be back next week. Thanks for joining us here on The Close. Stick around. This is Bloomberg.